Okay, so in this video, we'll talk about how to account for an equity investment when you hold between 20 and 50% ownership of the company you're investing in. So we usually presume with this level of ownership that you have significant influence over the company's decisions. And if you get a question where they ask, where they give you a company with exactly 20% or something like that, do you account for it using fair value or equity method accounting? You're going to have to, the problem should tell you at that point. It wouldn't be ambiguous. But again, okay, if it's under 20%, fair value method. But if it's in this category, between 20 and 50, we're going to use equity method accounting. Yeah. So what do we do with equity method? We record the investment as cost, as always, no matter any method. But then what we do, we're going to adjust the cost every period for our proportional share of the earnings or losses of the company we're investing in, and any dividends we receive from the company. So it's different though. It's different than the fair value method. In the fair value method, the company you're investing in can report any kind of income and there's no effect on your end. It's great that they're earning money, but here we do adjust the base. We increase the base by our share of the net income. So if they reported $1 million in net income and we owned 20% of the company, or say 30, let's say 30. So we own 30%, we would adjust our investment. We'd increase it by 300,000, 30% of $1 million. We would also have investment income of 300,000. And the dividends are accounted for differently too. When that company pays a dividend, we reduce the base of the investment, and we don't receive dividend revenue. No such thing as dividend revenue in this case. Why is that? Well, because we own such a big portion of the company, it's like we're paying ourselves. Okay. So, here is a great contrast. On the left-hand side, got the old fair value method. On the right-hand side, we have the equity method. So we're going to go through one example, and we're going to see how we account for it under both styles, both two different approaches. And because we're going to use an example where you have exactly 20%, so it could go either way. Let's start off. Maxi Company is going to acquire 48,000 shares of Mini Company common stock at a cost of $10 a share. And that amounts to 20% of mini stock. So 48,000 times 10, we have equity investments go up by $480,000. Cash goes down by $480,000. And that will be exactly the same for the equity method. Starts out the same. All right, so then during 2014, Mini Company reports net income of $200,000. Maxi Company's share of that is, of course, 20%, or 40,000. So 20% of the 200,000. Under the fair value method, we have no journal entry, right? We don't care, or at least accounting-wise, we don't care about their net income. Under the equity method, however, we get to recognize revenue from investment, or sometimes called investment revenue. And that equity investment account, the base, will go up by that amount as well. Okay, also at the end of the year, for the 48,000 shares of Mini Company now have a market value of $12 a share, or $576,000 in total. Remember, again, we paid $480, and now they're worth $576. Under fair value method, we increased the fair value adjustment account by $96,000. $96,000 is the difference between the $576 that they're worth now and the $480 you paid for. And we would have an unrealized holding gain or loss hyphen equity. So you have this unrealized gain here. Under equity method accounting, no journal entry for this. Let's move on to the next year. January 28, 2015, Mini Company announces and pays a cash dividend of $100,000. Maxi Company receives 20%, of course, because they own 20% of the shares, or $20,000. Under fair value method, you get dividend revenue. Okay, that is revenue for you. Under the equity method, it's a little different. You still get cash, of course. I mean, that's just a fact. You get cash, but there's no revenue. Instead, your base in the investment goes down by $20,000. We knock down the equity investment account. All right, let's keep going with 2015. Mini reports a net loss. So instead of net income, they have a loss for the year of $50K. And our share is 20% of that, or $10,000. Under fair value method accounting, there is no journal entry, but for equity method accounting, we have a loss on the investment, and our equity investment account will, the base in that will go down. Okay, we'll keep going. One more. Here we are again at the end of the year. The fair value of the mini company shares is now $11 a share, or $528,000. So you remember it was $576, and now it's $528. And so if you do the math, the difference there is, let me see, be $48,000, yeah. So if you're using the fair value method, you need to go ahead and recognize an unrealized holding gain or loss. It's a loss, actually, in this case, hyphen equity of $48,000, and credit the FVA account of $48,000. Under the equity method accounting, however, you don't have any entry necessary. And so this is a great example to study. This really highlights all the differences in accounting between fair value and equity method. Now, if you have investments in equity securities where you own more than half of the company's stock, you have a controlling interest, and you're the parent, they're the subsidiary, you just consolidate your financial statements. Pretty straightforward. Also, let's cover the fair value option briefly. So like everything that I said previously was true, but the FASB has recently introduced this fair value option. So even if you use equity method accounting, you have the option to report things at fair value. So if we back it up to that, that chart here, you see the spaces where I have no entry for equity method accounting because you're not required to recognize changes in fair value. You're not required, but you now have the option. You can say, I'm going to elect to use the fair value option, and I will record changes in fair value for this asset. It's applied on a financial instrument by instrument basis, so you can do it for one security but not another. It's up to you, but you can't do it one year and not do it the other year. So you can only use the option when you first buy the financial asset, or you can use it on liabilities too, but you can only do it when you first incur that liability. Does that make sense? That should make sense. You got to declare it right then. You can't wait to see if you have a gain or a loss and say, oh, well, I had a loss, so I don't want to do it. You can't do it. And you got to use it the whole time you own it from then on out until you no longer own it. Okay, let's see how that works here. You got McCollum Company buying stock in Fielder Company, and they're going to make it available for sale. At the end of the year, the cost is $100K, but the fair value is $125. If they did the fair value option, it can make the following journal entry. Equity investments will go up. Unrealized holding gain or loss hyphen income. You see how it's income here? Even though it's available for sale? It's because they use the fair value option. Okay, that's the other key difference I want to highlight. If you use fair value option, your gains or losses will hit net income. Okay. And let's look at another one here. Sullivan Company has a 28% stake in Supin. Sullivan bought it for $930, and then at the end of the 2014, the fair value is only $900. They elect to use the fair value option. So here we have an unrealized loss of $30K. And again, it's hyphen income because it's the fair value option. So even if it's available for sale, it is going to be recognized in your net income. An equity investment account would go down. One more topic, impairment of value. every investment you have at every reporting date, meaning the end of every fiscal year, really end of every fiscal quarter, you got to determine if it suffered a serious impairment. An impairment is a loss in value that's other than temporary, and it's going to be a realized loss that's going to hit net income. And do a fair value test. Let's have a look. Strickler Company, they have available for sale bond securities with a par value and cost of $1 million. The fair value is $800,000. Strickler has previously reported unrealized loss of $200,000 as part of other comprehensive income. However, in evaluating the securities, Strickler now determines that it will probably not collect all the amounts due on these bonds. So now we have an impairment that is other than temporary. Previously we thought it was temporary. That's why the loss went in other comprehensive income, but now we think it's not temporary. So now we have a loss on impairment, which will not go in other comprehensive income. It's going to hit your income statement, and we're going to lower the base value of those debt investments there. So it's a serious impairment. Let me see if there's anything else I want to talk about on these slides. Okay, fair value disclosures. Fair value information, the FASB has decided that it is useful for making business decisions, but there are concerns over its representational faithfulness. So everyone pretty much agrees it's relevant, but some people say, well, for some financial assets, I'm not sure how much I can trust the fair value. So what you have to do, you're going to have to report a lot of things in the footnotes of the financial statements. You got to report the cost and the fair value, and you got to give people enough information to determine how much usage of fair value and the inputs used to implement it. A few other reasons for additional disclosures are this. Number one is there's differing levels of reliability in the measurement of fair value information. Some are more reliable than others. And changes in the fair value of financial instruments are reported differently in the financials, depending on the type of financial instrument involved. Okay, and here's the hierarchy. You guys should know this for sure. I think this is important. So when you look at a company's public financial statements, you see fair value, you better dig in the footnotes and see what level it is, okay? Because level 3 is like the least reliable information. So you wouldn't trust that as much as level 1. Level 1 is fair value based on quoted prices. So this is like, hey, we own stock in Apple, and Apple's latest stock price is X dollars a share. That's very reliable. Level 2 is a little bit less. It's like, hey, we own this bond. It's not traded much, but here is the fair value of several other bonds that are similar. So, okay, you're going to get the fair value from that. Level 3 is very unreliable here. You're going to use unobservable inputs here. You got some kind of model to determine the fair value of this instrument. Yeah, so very important to know about that, levels 1 through 3. And I'm just going to skip through this. I don't think there's anything else I really want to say. Nope, that is it. That's the end of the video.